Good afternoon, everyone. Thank you all for joining in today, and happy Pongal to those of you who will be celebrating in the next few days. We wanted to start having a conversation about guilt because this is something that Roshan and I are encountering in a lot of conversations with investors, whether this is the right time to take on some duration risk, what is the best way to play this strategy in 2024. So that is the background behind why we started this conversation. And just a couple of things. Uh, any questions that you have, you can type it into the chat and we'll get back to it at the end of the presentation. And there will be enough time for Q&A. So please, whatever is on your mind, feel free to ask us and we'll be happy to talk to you about these things. So without further ado, let me begin our presentation on Gilt, whether it's going to be worth the trade. What are the data points that we are looking at today? So the first part is let's try to understand fixed income as an asset class and see how returns are made, right? So let's break down what are the different components of returns that you have with fixed income. So we can sort of split it into three components. One is your coupon payment. So if you have a bond or a fixed deposit and you say, oh, I'm getting a 7% interest on this, that is basically a 7% coupon, which is going to get paid to you on a regular basis, typically on a 1 year basis, right? Then there is something called a mark to market movement, which basically is what the price of your investment is. Now, the price of the investment in the case of a fixed deposit doesn't change. What you are giving, you're lending that money, you get the full principal back. And over and above that, you get your interest payment or your coupon payment year on year. But when you have a bond, then on a day-to-day basis, just like how stocks get traded in the market, bonds also get traded in the market, and people are willing to pay a different price. So if you bought a bond at 100 rupees, maybe someone will be willing to buy it from you at 100.1 rupees, or they might be willing to buy it from you at 99.9 rupees. So it's not necessarily going to have the same price of 100 rupees every day. So that is your mark to market movement. And there are many factors that will influence the price of a bond. And we'll get into that through the course of the presentation. And the last source of return is re-rating. So re-rating means that either the market perceives that this is going to be a better investment than it did before. So typically you will see this in the credit side. So if you had a company that had a double A rating, and then over a period of time, because their balance sheet improves, because their ability to repay their debt improves, they might get an upgrade from say double A to double A plus, and that re-rating will give you an additional source of return. So these are basically only the three ways in which you can make returns on fixed income. So as an investor, we need to think about, okay, what is the goal that I'm coming with? And will I be able to achieve it? And which source of return is going to help me achieve that particular goal? So when it comes to coupon payment, you're basically looking at a borrower paying the lender something that we call interest. Now, in today's market, that coupon can be fixed or it can be floating. So RBI has a floating rate bond on which every 6 months they decide what the coupon is going to be, right? So how much interest is the saver going to earn? That number changes, right? The returns typically with coupon are predictable and they're stable. So unless the bond is floating, you will know in advance what is the return that you're getting, what is the interest or the coupon payment that is going to happen, and how frequently that payment is going to happen. So your typical products which do coupon payment are fixed deposits and bonds. So notice that things like mutual funds will not actually do a coupon payment. So there is no guaranteed or expected return in the mutual fund investment. Then when it comes to market, we can think of the relationship between yields and bonds as a inverse sort of relationship, or you can imagine it as a seesaw. The yield is basically the total kind of return that you're expecting, right? So if the price of something reduces, automatically our return will increase, right? Because we are buying at a cheaper price. If the price increases, then our return is going to reduce. So it's a seesaw kind of relationship where your and your bond price will move in opposite directions. So when the yield is high, the price will be low. When the price is high, the yield will be low. And now to look at mark to market return, there is a simple formula that most people use to calculate what the mark to market return would be. So if it is basically the difference between the change in the yield multiplied by the modified duration. Now the modified duration is it's a particular statistic. We won't get into that because it's quite technical. But essentially, it has something to do with when you're going to receive all your income from the bond back, and it is related to how long or what the maturity is left in that particular bond. So a 10-year bond will have a higher modified duration than an 8-year bond if they both are paying the same level of interest. But again, so uh, modified duration statistics are published for most bonds as well as mutual funds. So you don't need to get into what exactly it is, but this gives us an estimate of, okay, how much can I expect in terms of mark to market returns if there is a change in the yield, which is what all investors are anticipating today, given that for most of last year, we did not have the RBI hiking interest rates. Now the Fed also in December has come out saying that uh, with a fairly strong pause and some dovish commentary. So people are expecting that we are at the turn of the interest rate cycle. And if we are turning in the interest rate cycle, definitely there's going to be a change in yield. Every time the yield, so again, here this negative relationship between yields and prices are noted because here we are doing a minus modified duration into the change in yield, right? So the if the yield is reducing, you will make a positive return. If the yield is increasing, you will make a negative return. So when it comes to re-rating, your interest rates and yields can also give a re-rating. If overall interest rates go down, then obviously higher coupon bonds will have more demand in the market and automatically their prices will come down. Uh, their prices will go up. Then you have credit rating, which we've talked about, and the last re-rating is through credit spreads. So if the difference between your government borrowing and your AAA debt and your AA debt is very little compared to what the historic average is, then there is a possibility for spreads to widen, that is to return to their normal levels. In that case also, you can think of that as a change in yield. If spreads widen, then you are likely to face a loss in your portfolio. If spreads contract, then you are likely to make a mark to market gain in the portfolio. And now moving on to part two, which is the setup for your gilt trade, which is government securities. The reason why we like government securities is because they have a sovereign rating, which means there is no risk in owning it. There's no worry that, okay, maybe I'll not get the interest payment or this money will not come back to me. That fear is completely not there. The second advantage is that they're quite sensitive to interest rates. So the longer the duration of the bond is, the more sensitive it is going to be to changes in the interest rate. In terms of the gilt fund, right? There are options where there is no exit load, which means for an investor to trade in and trade out of the fund is fairly easy. And that also means easy entry and exit because it's liquid. Ideally, your government bonds are the most traded bonds in the market. So even from the fund manager side, that would be easy to change the portfolio. And it allows you to take a very active duration call. So now, when you say you want to buy a constant maturity or a long-term gilt fund, you're very clearly taking on duration risk with the intention of either mapping to a longer investment horizon or with the intent of maybe making some mark-to-market gains in this investment. So let's take a look at where our current spreads are. If the blue line is your 10-year bond and the green line is your 1-year cost of borrowing. So for a large part of uh, 2023, we were seeing that your 1-year cost of borrowing is actually higher than your 10-year cost of borrowing, because there was a fear that at any point the interest rates could go up. Now, typically these reset at the beginning of the year, so you can see there is some kind of like spike in the cost of borrowing or drop in the cost of borrowing at the end of 2023 and a spike in the beginning of 2023. Now, normally there is something known as a term premium, which is that if I'm lending money to someone for 1 year versus if I'm lending them money for 10 years, I would expect the 10-year to pay me more than the 1 year, right? So now we have to see this sort of reverse and sustainably reverse, right? So if my 10-year cost of borrowing is going to be somewhere around 7.1, 7.3%, then my 1-year cost of borrowing has to come down. Right? Alternatively, if my 1-year cost of borrowing is going to be at 7.2%, then I need to increase my 10-year cost of borrowing as well. So the spreads are not normal, and we need to be cautious of the fact that there could be a change in the spread. How this change will happen, I think nobody can be 100% sure about which direction it's going to move in. So similarly, if we look at compared to the repo, what has been the uh, difference? Now the 10-year again, if we look, is your blue line, the 1-year is your yellow line, and the repo is your green line. So in 2021 to 2022, the repo basically sets the cost of borrowing for the overall economy, right? And then over that, you'll have the 1-year government cost of borrowing, and then above that lies the 10-year. So if you see maybe late 21 to about maybe 2023, you had a very normal spread, meaning your 10-year was on top, your 1-year was below, and then you had your repo. But in 2023, you see a big inversion, right? The spread between your repo and your 10-year is very little compared to what it was in the past. That is basically the height difference between these two. So there is some gap to fill, and we need to understand that even if the interest rate comes down in 2024, the spread has to come back to its normal level. So can we be really sure that the 10-year will react and that you will have a change in yield there and a mark to market gain? That is something we need to think about today. And overall, in terms of how is debt looking for India, I think here India is still a bright spot. We are hearing a lot of that on the equity side, on the equity commentary, but even on the fixed income side, India seems to be a bright spot. So the flows into debt in 2023 were positive every month except for March 2023, where there was a negative outflow. But foreign investors have been buying domestic debt throughout 2023. There's also been, after a long wait period, there was the bond index inclusion. So now you have the JP Morgan index. You have other global indices also looking to add Indian sovereign bonds to their global ETFs. So now if Indian bonds are on these indices, then more and more demand will be there, and you can expect more flows into debt. Also, given that if you're seeing lower yields, etc., across the globe, generally there will be a carry rate that comes towards emerging market debt, not only for India but for other countries as well. So let's look at the math behind the trade. Does it actually work? Now, let's say, given all the data that we looked at, how spreads need to come back to historic levels and all of that, let's say the yields actually decline by 0.25%. Now, the capital gains that you'll make through MTM is about 1.7%. And if this yield decline happens in 1 year, then you also earn that 1 year interest of 7.25, which is where our current tenure is. That's the coupon on the current tenure. So your total return is going to be the sum of these two, which will give you about 9% as your return. But if that 0.25% change in yield happens over a 2 year timeline, that is, it doesn't happen in 2024, but it happens through the course of 2024 and 2025, then your overall return comes down by another 1% and you're at 8%, right? And if it happens over 3 years, then you come down to about 7.8%. Now, similarly, if the yields decline by 0.5% in this time frame, you will make a 10% return in 1 year, a 9% return in 2 years, and about 8.3% in 3 years. And if it's even steeper and you see 0.75% decline in yields, then you could make a 12% return. So when investors have made this trade in the past, they have made something like 10%, 20%. Those are the returns that you're looking at. So uh, clearly, we are not in that phase where you can expect a 1% change or a 2% change within a 1 year time frame, because our average levels are still not, we are still not at the average level, and we can't go down too much from where we are. Also, there are other factors that we need to look at. So the other side is that what if the opposite happens, which is that we are still seeing higher inflation numbers, we are still worried about inflation, and it is an election year. So there is obviously some concern around, are we going to maintain the fiscal deficit? Are we going to go overboard? So all of these fears are reflected in the bond market. It's not necessary that these things have to happen, but they are on all market participants' minds. Which means if you see a 0.25% increase in yields, that is today from 7.2%, if we go to 7.4 and a half or 7.5%, then it's very likely that your return will not even be the 7.25, it will be lower than that, and you'll be closer to 5.5%. So the important thing for any investor today is to think about what are the risks, and am I comfortable with both scenarios? That is, if I'm wrong today, am I okay to earn 5.5? Am I okay to layer this decision? How will I course correct if I'm wrong on making the call today? If I'm right, of course, there's no need to adjust your course, or look at how to play the strategy. But overall, the long term story for India does remain positive. Like I mentioned, we have bond index inclusion, which is a positive thing for yields, because as there's more demand, your bond price will go up, and your yield will come down. So, from a mark to market perspective, there is some potential for return. We've also had improving macro fundamentals. Yes, inflation is not at 4%, but we've come a long way from 2021 and 2022. Sorry, 2022. We also have been better with fiscal consolidation, meaning that GST numbers have been good, tax revenues have been good, spending has been within control. Uh, and so all of these things have contributed positively. Crude oil has been cheap, our exports and imports have been well balanced. So all of these factors are actually positive in terms of bringing the yield down. There is a scope for ratings upgrade if we continue in this trajectory for a reasonable amount of time. We have an inflation targeting mandate. So while we are not at 4%, it's not that the RBI has ignored their mandate, right? They have consistently talked about coming back to that mandate, bringing getting to 4% consistently. So there is some directional move in sort of bringing inflation under control. And even like I mentioned, your trade deficit, all of that is narrowing. So from a structural perspective, yes, there are a lot of factors that could move the yield downwards, but there are factors that may prolong this journey, and it's not something that will happen overnight. And definitely, a rate cut is not the strongest uh, signal or factor in this story, because you can see all of these are contributing quite a bit. And what are the risks today? I think the first is that there is dollar strength. and that there is a risk off sentiment, which means that ideally, if your dollar is stronger, flows into Indian uh, investments may be reduced because there could be more demand for dollar denominated assets. The second is that you have election spending that's going to happen. You're going to probably see some populist policies that could push yields up. So that is something that we need to watch out for. The big risk that people are not yet talking about, but you will see in the newspaper, is that we've had erratic monsoons throughout 2023 and our reservoir levels are low. So another year of bad rains and bad monsoons could really change a lot of the equations that and assumptions that people have built today. And there is a global slowdown. So paying attention to central bank commentary, paying attention to the fact that markets are expecting rate cuts, that's not actually good news. That's bad news is good news reaction, because central banks are talking about slowdowns. You're already seeing that on the US as well as the Europe side. Um, with high inflation and slow growth, that's not a really great combination. Now your inflation is moderated, but it's still higher than what most economies have been used to for the last couple of decades. And there are rising import requirements as well. And if we look at the spread data which I showed you, you're at low historic spreads. So with this, I'm done with my part of the presentation, and I will hand over to Roshan.
Yes, thank you. Okay, okay, great. I think I have control, right?
Yeah.
Okay. Okay, so let's get straight to it. So for 2024, what do we expect? So as we already saw for the last few months, the yield curve has been relatively flat. And if you see the actual RBI policy rates, we are close to the peak. That's the general consensus right now. And we are also expected to stay higher for a while. And I'll get to that in a little bit as to why we're expected to stay higher for a while. So as we stay higher, we can expect the yield curve to steepen again. And this is just reverting back to average, or rather back to mean, right? So with the steeper yield curve, your long-term, short-term spread that will also widen. Right? And wider corporate debt spreads. So we are in a healthy credit cycle, right? And the re-rating point, which we saw earlier, and with all of these factors, we can expect the spreads between the AAA, AA, and A-rated papers, which is again your corporate debt spread, right? This to widen again, and this will obviously give investors a better risk-reward ratio when you go lower down the credit ladder. So coming to why rates are expected to stay higher for a while, right? India is in a unique position. We saw what our advantages are, right? We have we have great macros. We have the global bond index inclusion coming in, right? So we are in a unique position that even though we're near the top of the rate cycle, we're still growing, right? Growth still looks really good. And this gives the central bank a lot of leeway in holding rates. And since the need to stimulate growth is kind of non-existent right now, because you already have growth, you still have decently high rates, right? And you have excellent macros. So taking all of this into consideration and also the bond index inclusion happening, we can expect more FII flows to come in, and India looks like a really good destination for FII inflows into fixed income. Sam, it's not moving to the next slide. Okay, great. Okay, so let's look at some safe investments, right? So post office saving schemes. Some of us know about this, some of us don't. So I'll just take the liberty of running everyone through this. So first of all, these schemes come under the ambit of the central government. So this comes with a very high degree of safety and also fixed returns. The monthly income scheme, which has a minimum investment, a maximum investment of 9 lakhs for a single account and 15 lakhs for a joint account. With this scheme, you invest a certain amount and you earn a fixed amount of interest every month. So this is 7.4% per annum, and that is divided by 12. So that's how much you earn every month. The scheme comes with a 5-year lock-in, and if we're talking taxes, interest earned is taxable and ATC is not applicable here. So this is not, tax deductible with the ATC provision. With a PPF, the Public Provident Fund, you are allowed to invest up to 1.5 lakhs per annum, and that'll earn around 7.1% per annum, but you have a 15-year lock-in here. And the interest earned is tax-free, and your contributions to the PPF is tax deductible under ATC, right? The Senior Citizen Savings Scheme is open for anyone over the age of 60. This is for regular citizens. For government employees, the age limit is reduced to 55. And if you were a veteran employed under defense, the age limit is lowered further to 50. Right? So the maximum limit for the Senior Citizen Savings Scheme was recently increased last year's budget. It was increased to 30 lakhs from the previous 15 lakhs. And this also offers a higher return of around 8.2% per annum, right? And this comes with a 5-year lock-in. Again, interest earned is taxable. Interest earned more than 50,000. Like if you earn more than 50,000 a year, that is taxable, and the contribution is tax deductible under ATC. Right? So the National Savings Certificate can be opened in anyone's name. It has no limit on the quantum of investment. It is tax deductible under ATC, but only up to 1.5 lakhs. But there's no limit on the contribution per annum. And it comes with a 5-year lock-in, and it offers a 7.7% return. So the Mahila Saman Savings Scheme was introduced in April 2023. It's a one-time scheme available from April 2023 to March 2025. So it's open for these 2 years, but it can only be opened in the name of women, and it'll have a maximum deposit limit of 2 lakhs with a 2-year lock. Now let's go to the National Pension Scheme. So with the NPS, you make contributions to a pension account at regular intervals, right, during the course of your employment. And after you retire, you can take out a portion of that corpus as a lump sum, and you receive the rest as a monthly pension, right? So the interesting thing about the NPS is portion of your investment goes into equity. So it has a lot more potential for upside when compared to a PPF, but it also carries higher risks, right? But there are certain restrictions on the NPS to reduce this risk, but we'll get to that later. You can see the returns of a few of the NPS schemes on the screen right now. Another unique feature about the NPS is that if you're not happy with the performance of the fund, you are allowed and you have the option to change the fund manager. So for risk control, right now there's a cap on the range of equity exposure for the NPS. right? You have a 50 to 75% range on equity. For government employees, this cap is 50%. And the equity portion will automatically reduce by 2.5% each year. Like the cap on equity will automatically reduce by 2.5% each year from the year where you turn 50. So from the age of 50, your equity portion will automatically start reducing. And for an investor who's at the age of 60, the cap is fixed at 50%. And all of this is to reduce portfolio volatility. Yeah. Okay, so let's take a look at what we did in 2023. So we had a positive bias on short-term funds, AAA deposits, and your corporate bond funds. So our strategy was largely focusing on 100% AAA. Some funds would have very little AA exposure, some of the corporate bond funds, but they were largely 80-90% fully AAA portfolios, and we were focused on the 2 to 4 year part of the yield curve in terms of duration, right? And this approach has worked really well for the past year, as you can see in the returns, especially with the short-term funds, and the largest portion of our portfolio was invested in the short-term fund space, followed by the corporate. Followed by the corporate bond fund, and the rest in corporate deposits. Right. And looking to where we were underweight on long duration funds, we were underweight on target maturity, and we were underweight on arbitrage. So arbitrage outperformed our expectations, and you can clearly see that being the top performer on the higher end, right? But our underweight calls on duration and target maturity worked really well to our favor, as the flat yield curve didn't really give us the incentive to take that sort of higher risk. Right? So let's see what you get with Finesse. Right? So with Finesse, you get a multitude of benefits. We regularly engage with you like this. In the form of monthly webinars. You get our monthly fixed income outlook on the first week of every month, where we talk about opportunities in fixed income investments, local monetary policy, global monetary policy, whatever the flavor of that month is. If there's any big macro event, or any event in terms of fixed income markets, in terms of monetary policy, right? All of that will be covered in our monthly investment outlook, right? And again, we also help you build your fixed income portfolio. We help you with your asset allocation and your product selection as well. Right. And also, if you have an existing investment portfolio, whether it be equity or debt, here we can help you with restructuring. Like, we have an equity team, we have a fixed income team, and we can help you with any of your we can help you with reviewing any of your existing investments. Yeah. With that, we can open for Q&A. We'll start taking questions on the chat box.
Okay, so I think the first question is already up, and it says, considering central bank action towards rate cut initiation this year, probably in March, will more FII inflow or outflow in India? So I think first is, if there is a rate cut, you can normally, what would happen is you have to see how the yields react, right? So right now the markets have already reacted quite a bit to the US rate cut. So if we look at what the US yield was in September last year, you were close to 5% on your 10-year treasury. Now you are already maybe sub 4% or around 4%. So there's been a huge rally for the rate cut anticipation. So, in terms of that affecting flows, I don't think you will see anything coming forward because we call it like priced in, right? Like it's already priced in. People are expecting the rate cut. Um, and that happened with the Fed's announcement in December. But until December itself, the bond market had already rallied. Even before the Fed came out and publicly made this statement, you had that happen. We talked about the election impact. Will there be any impact due to US elections this year on these bonds? It's very difficult to say because honestly, there's no idea. The US election is at the end of the year, right? Like we're going to see the results come out only in November. I don't think that you can try to calculate that and make a decision based on that. Okay. My limited understanding, corporate bond yield spread are almost reduced. What is your opinion? So again, the corporate bonds is a very wide universe, right? If we're talking specifically about NBFCs, then I think there we need to be a little cautious because the RBI has basically made some adjustments to the risk-weighted assets, which come into effect in 2024. So there will be a higher level of provisioning, there will be a higher cost of capital maybe for certain players as well, which means that you might get more in terms of yields. Also, you're seeing more people come into the market to borrow, which was not the case maybe 2, 3 years ago. So there, that supply of bonds may also have an impact on the overall yield. And spreads have to widen still, in our opinion, but we could be wrong as well. I just want to put that out there.
Okay, I'll take the next question.
Yeah.
I'll take the next question. Yeah. So, while talking about re-rating, how can we believe in present credit ratings? For example, a state government company is with an A plus rating, whereas private companies have better ratings. Okay. So when we look at ratings in this aspect, right? The first thing is the ratings are based on the balance sheet. The ratings are based on the balance sheet. It's based on earnings outlook, current earnings, right? So they're basically mostly quantitative factors. So a state government company can earn less than a private company. If you look at Tata, Cholamandalam, right, their earnings are pretty stable. The balance sheets are better than state government companies, but with a caveat. So if the state government, for example, the Maharashtra Electricity Distribution Company, right? So I'm not familiar, but if this is guaranteed, if the interest and the principal is guaranteed by the state government, you'll have A plus, but a sovereign rating. In that case, the backing is by the company as well, but also in case the company fails to pay the interest, the state government will pay that interest and the principal as well. So again, talking about rating companies, we can go back to 2018 or even further back to 2008, and we can point out flaws, right? But it's still very quant based. It's balance sheet based. It's income based. It's outlook based. So yes, there are. Again, having a state government company having a lower credit rating, whereas private companies having a higher credit rating, is not something to worry about. Sam, do you have anything to add to that?
Yeah, I think also to add, right, like your rating is a static measure, meaning at the time of issue, the company for that particular security gets a rating issued, right? And then you can, it's also a function of the structure. So let's say guarantee is one element, but catch up is another. There are a lot of different elements in the bond that will determine its rating. So something that has underlying collateral will have a higher rating than something that is not secured, right? So That could be the reason for the difference. The second is in terms of track record of repayment as well. So, is this company, does it have a strong track record of repayment? What is their balance sheet like? How often have they raised capital? What are their assets like? So, these questions will also influence the actual rating. And you can see companies like Cholamandalam, how their rating has improved over the last 10, 15 years, right? So this is more of a long-term story. And to add to Mr. Shekhar's question, yes, we do help investors with bonds, and you can get in touch with us. I've also shared the contact details, so anybody who wants to get in touch can note down the number and drop us a message. So while buying bonds, what are the points to be looked into? So we can tell you what we look at. The rating is there, but we do study the balance sheet. We look at the promoter history. We have certain metrics which are proprietary that we track in terms of the balance sheet as well. And then over and above that, we look at the structure of the bond. So is it secured? Is it not secured? Is it perpetual? Is it what are the features? What is the frequency of payment? Is there like a step up option? So all of these things would sort of add to our decision making framework. Okay, I think if there are no more questions, then we can wait for one more minute to take any questions and then we'll close. Thank you everyone for joining us today and have a good weekend.
Yes. So thank you guys. Happy Pongal, and yeah, we'll see you in the next one.